Good morning, good evening, wherever you are. For those of you who are observing Memorial Day in the US, I know the market is not open today, but we are still here because, yeah, there were some movements in the portfolio. And I also want to take the chance, since the market is closed, to actually build out the remaining parts of my SOFI valuation because it kind of got broken a couple of quarters ago and then I didn't get to fix it. And I think the biggest news um, that has, well, sort of been around in the last week is Amit and Steve interviewing Anthony Noto. And on last week's basis points, when they said that they have the two CEOs coming on board or coming, the interviews coming, I did not expect Anthony Noto. So it was really a breath of fresh air. The way that he spoke about the company, I think it gave me a lot more confidence. And I think sometimes when you listen to him speak in the earnings call, it can be a little bit mundane. Yeah, but at least yesterday, or not yesterday, over the weekend when I was listening to the interview on Basis Point, I thought there was pretty high conviction on that. Hello, Jerome Powell. Nice to see you here. All right, just give me a minute. Let me make sure everything is set up. And so, although the market is closed, we still are in a little bit of a limbo when it comes to the US Iran news. I woke up to news that there's an announcement that the deal is largely negotiated, and then after that, I went out, I came home, and then suddenly it became we are in no hurry to make the deal. So you know what? Basically, we are back to square one. Nothing has changed. And I think that there's only so much that we can do. I think during that interview itself, Anthony Noto did mention a couple of things, which I feel like I already mentioned in the previous SoFi video that I put out right after the earnings, right before the earnings, sorry, regarding especially their guidance, right? So the reason why I'm doing this spreadsheet on screen right now, because otherwise I wouldn't have a better time to do it. And the next two videos I'll be doing will be on the Glamsterdam update, which affects Ethereum and BMNR, because we always talk about BMNR through a valuation of the ratio of ETH to BTC, but I don't think a ratio is a fundamental reason for a stock to go down. You're basically saying because it is so low, it will go up. And you're just assuming mean reversion. And I want to build a deeper thesis than that. And the second thing we want to do is to explore SoFi's valuation. And for most of you who have been following me for some time, you would have seen this Excel file before. We go all the way back to 2021. I mean, I wasn't posting content in 2021, but I was tracking the company. So the main purpose over here, while we are talking about the markets, is to also see whether or not we can fix part of this Excel file so that we can look at the valuation. Because one of the ways I look at SoFi's valuation is based on what Anthony Noto has told us. And Anthony Noto has told us that, in his opinion, SoFi can get to, I believe it's 50 million members by 2030. Yep, I have that model out to around 50 million members by 2030. He believes he can get there, and he wants to see 2 to 3 products per member. My assumption is perhaps we're just getting to 2 products per member for now, right? So I think it'll be interesting to see how this plays out. One of the things that I need to account for in the valuation, which I haven't, is actually the number of Galileo accounts and the tech platform revenue. I think it's good to hear Anthony Noto say it himself, that he is aware that they have built up expectations around the tech platform being the AWS of fintech. But I can understand rationale of, look, the tech platform is not the biggest part of our business. Because of that, resources are limited, and since resources are limited, we need to serve the company that needs it the most, and the company that needs it the most is the company that is moving the fastest, building out the most products, and in their view, it is SoFi. And which means that as long as lending and financial services continue to roll out products at the pace that they are doing right now, then I am perfectly fine with the tech platform taking a back seat for a while. Because you got to remember, Amazon built out AWS for themselves, and eventually, right, when they had excess capacity, they started to roll it out. Initially, when SoFi came to market, this wasn't articulated so clearly, so it made it seem as if like all three segments of the business were going to be built out together. And I think this is one of the clearest, in fact, in the last, during the earnings itself, plus on the Basis Points podcast, this was really one of the clearest that I've heard Anthony Noto articulate the thesis around the tech platform, and it helps us to value the tech platform. The streaming quality seems to be struggling. Is it the voice or the visuals? Is that my internet? Give me a second. When you say the quality seems to be struggling, is it the voice or the visuals? Or is my internet wonky? Video is pixelated. Give me a second. All right, let me leave the room, reset the camera, and come back in again. Give me a second. Okay. Hopefully, this is better. Let me share my screen. Yep, I think SOFI USD is going to be a big deal. I I think, like Anthony Noto said, a lot of their products are very enterprise facing, and because it's very enterprise facing, as a retail customer, even if you are a user of SoFi, you might not see the immediate ramifications of the things that they are building out. If they roll out SoFi USD, if a merchant that you interact with uses SoFi USD, you as a customer of that merchant, or even a user of SoFi, would not feel it. You'll just realize that, oh, the transfer happens instantly. You don't even know that you are using SoFi USD. Now, that being said, I do think there is a structural advantage for them, especially if the Clarity Act is being passed in the way that it is passed right now, because they are both a nationally chartered bank, right? And at the same time, they have their own stable coins. And so what Anthony Noto was saying is that that gives them a structural advantage compared to some of the other companies who are applying for uh, to become a national trust bank. He tried to explain the difference. I didn't catch every single point. I will have to go and listen to that again. But basically, they have the better license. It was something that they took it upon themselves to get way back when they started. So I think they're seeing the fruits of that foresight all the way back in 22, 23 right now. Okay, so the way that I think about it, there are a couple of things that are pretty interesting if you listen to what Anthony Noto said. And I want to talk about how that might or might not change our. There's no point changing the way we track SoFi right now. Okay. I think when some of these things start to become big and significant line items, as SoFi changes the way they report their line items, we will make the necessary changes. But if you listen to Anthony Noto on the Basis Point podcast, he did say that he sees, I think SOFI Plus was the one business line where he wasn't that sure about. I believe the numbers he quoted was around 160,000 SOFI Plus members in the last 6 weeks. So that's around 30,000 members per week. He hopes to get to 1 million members. And yeah, 1 million members. So that it's not a significant revenue driver. But for big business banking, for buy, sell, hold crypto, as well as stable coins, SoFi USD, all this can become $100 million businesses. Right? I think that's what they're hoping to do by the end of the year. I think it is fairly doable. Now, how would they report big business banking? Will there be another line, another segment item that I will have to account for? Maybe, I don't know. How are they going to account for stablecoin revenues? Is that going to be a separate line item, or is that going to be just wrapped up under financial services product? Because technically, it's not financial services. Stablecoins, part of it is financial services, part of it is enterprise facing. So we don't know how they're going to report that. There are a lot of if and ands and over here that we can't really address right now, but these are things that we have to consider, right? I would think big business banking is a completely new line item because that is a enterprise solution. Stable coins, yeah, it depends. I think right now they are focusing on rolling it out to enterprise, so that I don't know. So we'll have to see how they report that. So right now, what we have is in Q1, 14.7 million new SoFi members. And this growth rate, actually, you're going to see later on in the valuation tab, that this growth rate doesn't need to grow faster than 7.8% from now until 2030. That means that if Q1 2026 was the fastest ever quarter-over-quarter growth, for the next 4 years, they will still get to the 50 million member mark, which is pretty impressive. The lending and financial services split over here, there's no difference. And so basically how this is calculated, the way I calculate products, right, I don't assume a growth rate for products because the metric that to me is the most important is this products per member over here. So we only project out member growth. We do that by understanding their customer acquisition cost. I thought it was quite interesting that they told us about their lifetime value of a customer, and how it actually increased as they take on new products. So that is something that becomes quite hard to model because a lot of the numbers are only known internally within the management. But that's why I only can judge it based on revenue or perhaps even contribution margin or profit. Sorry. So the way I look at products over here is that I take this number, total products per member, multiplied by total members, that gets you the total products, and then basically split it up. And the ratio of the lending products and financial services product split should be pretty, should be pretty similar. Let me see. Yes, definitely. So I think that they are going, like initially I was thinking of buying Circle, and I still might, but I feel like SoFi has already given me an exposure to the stablecoin markets. So I might as well just buy SoFi because the thing about Circle is that they still need to build out their other business lines. SoFi already has other business lines. So to me, it seems like a no-brainer to just buy more SoFi. And if I have capital to deploy it somewhere else. Contribution will only be material from 2027 or Q4 2026. Yep. And even if that is the case, I think it's quite impressive that they are still. I don't know if you guys caught it. He actually said that, because of the strategy that we're running right now, we might not be as profitable, but we may grow a little bit faster than what we actually have been doing. Yep. I think that is true for the entire, it's not just true for SoFi. I think it's true for the entire finance sector because as an analyst, like as he was explaining, as an analyst, it's going to be quite the thing about institutional analysts, they have to justify the reasons why uh, they buy certain things to their clients, and you can't tell your clients, guys, hodl. I tell my clients hodl because a lot of my clients are my friends and family, and they are not going to uh, scream at me. But yeah, but for most other people who are managing funds and all that, you can't just tell your clients to hodl. And if you lose money, it's fine. It's part of the process, right? Not everybody is suited for that, and so because of that, a lot of these fund managers, analysts find it hard to recommend SOFI and other fintechs and finance names in this sector as long as rates are high. And I mean, with inflation coming in hotter the last couple of quarters, it is a little bit concerning. I personally don't think we see a rate hike, especially with Kevin Walsh over here. He's trying to change like the whole, I don't know, some metric that you measure inflation by, not going by PCE and things like that. I can't remember what was the exact metric that he's using. I'm not too sure whether markets will actually take to that. And I do think that there is a possibility that we see a 5 to 10% correction in the markets as a form of the markets trying to test the new Fed chair, as Tom Lee would put it. Yep. So over here, total deposit growth $40.2 billion. I think this is good. 48% year-over-year growth. Deposits per member still healthy, around 2,700. Now, this is the product mix. Now, one thing I want you to pay attention to is that the financial services revenue per product over here is $22.17. One of the things that Anthony Noto did tell us is that he was expecting crypto to become $100 million run rate business, or is it $100 million business, or scaling it to that level. I don't think he said $100 million run rate, because by the time they get to $100 million by the end of the year, I think it's going to be running at a higher rate than that. So basically, you take this, you multiply by $22.17. Basically, in the first quarter, crypto brought in around $5 million. So technically, we still need to make $95 million. How that's going to scale for the rest of the year still remains to be seen. Because this is really only one quarter. I wouldn't even count Q4 numbers as accurate because they were only open for 9 days. So one quarter of data, right? And crypto is considered under financial services. So you multiply it by financial services revenue per product, you end up with around $5 million from crypto. Not substantial at the moment, but as this grows, he said $100 million. So let's see, right? In response to this comment over here, by Espen Neo, yeah. So Kevin Walsh might propose that the 2% target. He actually explained his own metric for tracking inflation. I can't remember what is it offhand, but he might be in the camp that 3% inflation is acceptable. And I don't know if you guys know, but Anthony Noto did say that he is also in the camp where he thinks that inflation at 3% is perfectly manageable because of the technology that we have available to us today. Anthony Noto did say that. So that wouldn't be a bad thing. But I believe CPI still came in. Let me take a look. I do have the numbers over here. Let me share my screen. Yep. So if you see, this is, let me see what's CPI. So April was, yeah, you see, April we were up 0.6% month over month, 0.38% year over year. Consensus was 3.7. So we didn't come in much higher than consensus. But still, overall, it is a hot read. I mean, we were getting close to 2%. right? Core was 2.8 versus 2.7, largely driven by the shock in the Middle East. And like I said, with today's announcement, I don't think we are much closer to seeing an end. PPI should also be up. I think PPI was quite hot, right? 6% year over year. Core 5.2, consensus was only 4.9%. So usually I would say that this shows that inflation is going to last a little bit longer, at least through to June, July, at the very least. Hi, clap my dog. Yes, once SOFI reaches 20 to 30% ROE, its valuation won't be affected by macro as much. I agree. Um, I guess let me see. Okay, although you say that their valuation will not be affected by macro, um, I think they will not be as affected. I don't think that they will completely not be affected because if you take a look at American Express, which is something that SoFi Anthony Noto likes to compare against, they also saw a contraction during this period of time from 385 all the way down to 292. Although it's not as bad as SoFi, right? This is just a what 385 down to 300. It's like a 20% drop, right? Compared to SoFi, SoFi is nearly 50%. So of course it's much lesser. Bounce back, rejected off, and then we're back down here again. So there was still some compression in American Express, but not the same kind of levels that we are seeing with SoFi. But I think SoFi is a bunch of things. Rate environment is one. Their revenue mix is another one because increasing percentage of revenue contributed by lending means that they are technically seen as more rate sensitive. And plus, it's the first time that they did not triple beat. Yes, I am actually thinking of buying Leaps because when he said he's running out of cash, yeah, I relate to that. I'm also running out of cash, so we shall see. I might buy a little bit of Leaps this week. Let's see the price action. I mean, oil seems to be coming down today. So if oil is coming down today, maybe we get green markets tomorrow. Then I mean, I'll just wait for a little bit more choppiness. I don't expect us to be like up all the way from now until the midterms. I expect there to be choppy markets, so there are going to be opportunities for us to DCA along the way. I mean, the crypto pullback is. I actually spent the weekend reading up a little bit on crypto cycles. There are things I agree and disagree with. Okay, there's nothing to disagree over here. What I would say is that if Tom Lee is saying that the crypto winter is over, we're now in crypto spring, he needs Ethereum to close above 2100 by the end of May. Whether or not that will happen, we don't know because we actually saw Ethereum flush down to 2050 over the weekend, but it has since recovered, right? It has since recovered, if I'm not mistaken. Let me double check. Has it recovered? Yeah. Ethereum is 2124. So if we close above 2100, I believe it's like the third monthly close, third positive monthly close or something like that. And if that is the case, that is basically going to be like that kind of pattern doesn't happen in crypto winter. So if we get 3 consecutive green monthly closes, which let me share my screen with you. Then Tom Lee is basically saying that look, we cannot be in a crypto winter, we are in a crypto spring. If that is the case, okay, you know what? I'll give it to him. But until 31st of May comes around and we actually see ETH close green for the third month in a row, my assumption is that the crypto winter is still coming, or we're still in the midst of the crypto winter. Now, the one part of Tom Lee's argument where I can actually make sense of is that if you take a look at the historical crypto winters, Bitcoin tends to drop like 60, 70%. And then Ethereum, like the first crypto winter, Ethereum dropped like 90 over percent. Subsequently, it was around 70 to 80%. This time around, in the last couple of months, Ethereum fell by around 67%, which means we are pretty close to the levels of drop where we will see in the crypto winter. If you take it all the way from 4,900 down to 1,800, I believe that's around 67%. And then basically, to me, what I can see is that Ethereum, I think there are people out there calling for another leg down, which means I have seen people talking about Ethereum going down to 1,500, 1,300 to 1,500. Is there a chance? I am not a crypto expert, so I would never rule anything out. I take everything with a pinch of salt. I think I've done my valuation in the video that I just released on Friday. I don't need Ethereum to do much over the next 1 year, 2 years. I just need it to reach $3,000, and I've broken even. So that is where I'm standing, which is why I'm so chill about this whole crypto winter. I get it. If you bought it at a higher price, you might need a little bit longer. But that all of us has been in that position before. I've been in that position with SOFI, right? The first time I bought SOFI, I believe it was like $14, $15. I mean, previously when it was IPOE, I traded it quite a few times, or tried to trade it quite a few times. Really started a position around 15, bought it all the way down $4 or $5 ranges, and it stayed there for 3 years, right? Before we saw it overnight. After staying there for 3 years, overnight it went from $8 to $32. I actually still have this. I believe I have it in my computer somewhere. This receipt where I wasn't paying attention. I got margin called in one of my accounts, and my $8 SoFi share got called away for $9.50. So that was pretty funny. So I immediately had to buy it back. That was in IBKR before I moved over to Weibo. But yeah. So I think for me, I think the crypto part of it is also one of the reasons that is keeping SoFi down. But it's not yet a big reason because I don't think people relate SoFi to crypto at the moment. But yes, I do think that this is something that we will have to look at because we are going to see this grow to a big part of SoFi's business. Second thing is around their credit cards. You can see that they basically did not increase their credit cards by much between Q4 2025 and Q1 2026. And so the reason that we were given, this wasn't on basis points. I believe this was on someone else's video. I can't remember who, one of the other creators. I think it was Tavis and Roy, right? They spoke to the investor relations of SoFi. And basically, this is a unit economics thing. So they're just basically letting this is just a unit economics thing. They are going to plan to scale growth thereafter. So they have scaled it to a point. They are just trying to let profitability catch up, and then they're going to scale the credit card business thereafter. They already found what works. So SoFi Invest, SoFi Money, still both going to be driving growth. Credit cards are going to speed up in the back half of the year, I'm presuming. Crypto going to continue its pace of growth, and then you add on big business banking and stable coins. That is why SoFi did not lower their guidance despite rates being held constant, or the assumption that rates are going to be held constant. I just saw someone ask SoFi 31st or BMNR 41st. If you ask me, if I were to put a bet on it, I say SoFi 31st rather than BMNR 40. I don't know. Yeah. I don't know why I feel SoFi 31st. Okay, so that's how we came to the calculations over here. Then these lead to The second page over here, let me not confuse you guys with the numbers because I haven't worked them out. This is basically the segment financials where we look at their personal loan originations. Now, personal loan originations came in at $8.3 billion. However, because of how fast student loans grew, and how fast home loans grew, you can see on a year-over-year basis, student loans more than doubled. So if you take a look over here, student loans from $1.2 billion of originations in Q1 2025 to 2.6. Home loans, just 500 million up to $1.2 billion in home loan originations. And this is before rates even started to come down for the home loans. So I believe this will become a bigger and bigger part of their originations process. And so you got to see there are layers to this, right? So right now they have personal loans through the balance sheet and through the loan platform business. They have student loans and then they have home loans. Now the way they do their home loans, they sell off their home loans pretty quickly from what I understand. So because of that, it's already a little bit like the loan platform business, but they do tell us that they can expand their capacity there. Yes, he did say that, and I believe they did mention that on the earnings call as well. And I think this is where I appreciate Nodo coming on all these different podcasts because I think he's a lot more straightforward and his explanations are a lot more clear, I would say. Sometimes when he is at all of these investor what do you call it, earnings call, he's very by the book. And perhaps because he's the CEO of a financial company, the last thing he wants is to be hit by some bullshit regulatory nonsense. So that's why he's as conservative as he is. Total originations, $12 billion, 68% increase year over year. And I think it's amazing because their CET1 ratio basically dropped from 22.9% to 21.3%. Barely a drop in the bucket, which means that they can continue this pace of growth. If you imagine that every quarter they cut 1 point off their CET1 ratio, they can continue growing loans at over a 60% pace for the next 3 quarters, and they will still be at like 18 or 19% CET1 ratio, which is extremely healthy because JP Morgan is only at 16%. And so the way that Anthony Nodo explained this on the podcast, I believe, is that the cash flows from the loans, I believe it's like, is it 1,800 per quarter or something like that? But he basically explains how the cash flows will be generated from the loans for about 3 years. And so basically he's telling us that the build-out timeline for big business banking, for stablecoin and all that is going to be 3 years. So if you count 27, 28, 29, right? So, am I? Yeah, 26 to 27. So you're counting, let's say you're counting Q1 2020. Okay, so 2026, the whole year. I mean, it depends. Yeah, I mean, I guess you can count this year 26, 27, 28. So in 2029, Q1 2029 is probably the quarter where we are going to see the full effects of their entire flywheel, their lending business, financial services business, their stablecoin, as well as big business banking. And by then, you don't even know what else they're going to offer and how big their loan platform business and loan platform home loans and all that is going to be. So I think this is something that is worth keeping track of. So lending revenues, nothing much to see over here. One thing that I want to perhaps do is because right now the way that I've been tracking this, the marketing, where was it? I think that's the next page. The way I've been tracking marketing is by revenue generated per member. Maybe I should be looking at contribution profit to get a better idea. Maybe so maybe I'll model that in, but of course then that means the numbers will not look as nice. Okay, from here the quarterly numbers shouldn't be a problem. Basically the quarterly numbers are summing up the segment numbers. Okay, so one thing about the segment numbers over here, to me the most disappointing part about the tech platform is not that we saw a huge drop in revenue, is how much it affected the unit economics, which tells me that Chime, I know it was their second biggest client, but they are a high quality customer. They are not a customer that just wants to like compete on price and things like that. So it is quite worrying to see this drop off so much, which tells me also the 13 member or 13 clients that came on board. Like I don't understand fully what is happening over here. I don't think we got much uh clarity, I would say, around the process of onboarding a client through the tech platform, but it's rather a clarity around the narrative of the tech platform. The tech platform is there first and foremost to help SOFI launch products at a cadence that they want to, and then thereafter, it's going to be there to, it's going to be there to basically help to serve other companies within the same space. So for me, if that is the case, then this is not something I will be baking into my valuation considerably uh, until after 2030. Okay, so later you're going to see how it affects the valuation, but I just need to remember 57 cents, okay, and 132 million accounts. All right, corporate revenue. I think corporate revenue, it's going to be, they did say it's going to be more or less the same, right? So I'm just going to say average of the last 4 quarters. How about that? 56 million. And then we'll just do that for the rest of the year. Okay, let's see how that turns out. Quarterly numbers. Over here, nothing much to change. Adjusted EBITDA, 31%, healthy. Net income, 15%. This has to do with a one-time tax event that happened, and that is also why their EPS came in at 12 cents instead of 13 cents. You can actually see if you expand it out to the third decimal place, it's actually 12.3 cents. So you can see they were actually very close to delivering 13 cents on EPS. And if it's not for a one-time taxable event due to the share price movement, they would have delivered 13 cents of EPS. They told us to expect income tax basically to be a headwind of profitability, as well as their reinvestment back into business to be a headwind of profitability in the first half of 2026, and to expect profitability to ramp up from there. Now, I believe they're guiding for 11 cents of EPS in Q2 2026. My bet is that they're going to beat. Like, I think in Q1, they came in right at expectations because a lot of things happened that they could not have foreseen, which is basically the Iran and US war, driving up oil prices, causing inflation to spike again, having worries about rate hikes. These are things they could not have foreseen. So they already gave us the guidance in Q4. This happened. That's why they met. But with this in mind, now that with this in mind, with this all this information already available to them, they tell us that we're going to do 11 cents in Q2 2026. I call BS. Okay, I think they're going to come in at 12 cents, which puts us at 24 cents in the first half of 2026. And for them to get to 60 cents, they need to do 18 cents per quarter in Q3, Q4. If they're going to beat, I expect them to do more than 18 cents, which means perhaps 19, or even 19 and 20 cents. Yeah, because that's what they've been telling everybody. They're going to meet the 60 cents of EPS for 2026, right? So if they're going to meet the 60 cents of EPS, it's 12 cents first 2 quarters, and then 18 cents the last 2 quarters. So I'm expecting maybe 62, 63 cents actually of EPS. And he says that if we do 60 cents of EPS in 2026, there's a chance that we'll grow faster than we expect. And the faster than he expect, I am presuming, or the way I'm reading it, which means that we're going to be growing high 30s and into the low 40% range. What was Q2 guidance 10 cents or is it 11 cents? Because my expectation is in Q2, I thought they guided for 11 cents of EPS. Let me just go and double confirm that. Let me go and double confirm that. Q2. Because if they are guiding for 11 cents of EPS in Q2, I'm expecting them to beat 11 cents, which means they have to come in at 12 cents. 12 cents plus the 12 cents that they have put up in Q1 would actually put the first half of 2026 at 24 cents of EPS. Let me just double confirm. Where is it? Let me share my screen. Okay. So they didn't really give adjusted net income margin of around. They say adjust net income margin of approximately 12% to 13%. So let's see. I guess okay. So basically, if you use 12%, you get a 10 cents EPS. Use 13%, you get 11 cents EPS. So that's why I'm using 11 cents EPS, because they tend to beat the high end of their estimate, which means that basically, let me show you. The numbers are not fully accurate because I haven't really thought about my Q2 numbers. But if you go back into the spreadsheet over here, you can actually see how it changes. So in the spreadsheet, I just remove this blue box for you to see. The net income, if it's 12%, you see the EPS actually changes to 10 cents. Over here, if it's 13%, EPS changes to 11 cents. So that's why they're guiding between 12 to 13% of net income margins. I am personally expecting them to come in with a little bit of a beat. If they come in with a little bit of a beat, they should at least come in at 12 cents, 13.5%. Fairly doable, right? So I think that's all they need to do. And then in Q3, Q4, that's when we're going to see the huge spikes in EPS once they have gotten the tax burden out of the way and all that. So this page over here doesn't have too many things wrong with it. It's later on the valuation where I have to relook at how I want to structure it. Because and one of the reasons why I broke it, right, is because I tried to like integrate this within Cowork and then get Claude to update the numbers for me, and then some of the formulas got messed up. So I've been working on it. So far so good. I think I fixed most of it other than the valuation page. Okay, incremental margins. I won't talk about it now. I'll talk about it when I project out. This is the gain on loan sales. I haven't been super consistent in tracking this, but I know it's okay. Last quarter, no personal loan sales, right? But previously, it's usually around 5%, 5 to 6%, extremely healthy. They got that graph that shows us. So I that's why I haven't really tracked this very closely. Marketing efficiency. This is fantastic. If you can see how they have done their marketing, however much revenue dollar amount spent on marketing, this is always consistently around 30 to 31% of overall revenue. And then this basically drives customer acquisition cost. You can see customer acquisition fluctuates, I would say, at around $300. Sometimes they're lower than 300, sometimes a bit higher, like this quarter over here, Q3 2024. I believe that's because of the loan platform business, the launching of the loan platform business. I think apart from that, you can see generally it's around $300. If it's around $300, the revenue per member is around $74. Payback period is around a year. If you use contribution margins, then definitely I expect this to be a little bit lower, probably closer to 1.5 years, because you're talking about how much, when will the customer generate you enough contribution profit to cover their own costs, right? Not just revenue. Then there'll be a close. If it's around a 60% margin, then that's where you are going to see probably around 1.5 years or so. Okay, then I think we are getting to the part where everybody. Oops. Okay, so this spreadsheet over here, this is where I look at the valuations. Let me make sure everything is in order. Okay, how do I? All right. So, in I think what is wrong is that over here you can see the quarter over quarter numbers at the top. They are taking it from the key business metric page right at the front, but this valuation page should be a standalone file or standalone sheet, not dependent on the data that we have keyed in front, because in front is for us to track how the company is performing. This is for us to key in our assumptions over here. Um, but so far, okay, but right now the assumptions is that, like I said, in this quarter that just passed, you can see SOFI actually grew their member count at around a 7.8% quarter over quarter. Now, initially, I was using year over year to track their member growth. But in the last couple of earnings, Anthony Noto and Chris Lapointe both has been on the record saying that they have levers to pull every single quarter. And on a quarterly basis, they actually decide what levers to pull to drive growth in certain areas of their business. And if they're able to micromanage their business to such an extent that they can choose where the growth comes from, then I think it makes sense that management is looking at customer growth on a quarter to quarter basis as well. And you can see that is why on a quarter to quarter basis, this number has been fairly consistent. Whole year of 2025, you can see the average was really around 7.8%. Q1 2026 came in at 7.8%. My assumption is that this slows down for the rest of 2026, 7.5%. Then in 27, you get to 7%, 28, 6.5, 6, and then 5.5. And then with that, you get to Q4 2030 at around 48 million members. This is extremely close to Anthony Noto's numbers of 50 million SOFI members. Now, if you ask me, this falls short of his 2 million members, by his estimate by 2 million members, yes. But at the same time, are you going to complain that SOFA has 48 million members on their platform, not 50 million? I don't think so, right? So to me, I think this is a good enough estimate. I don't need to make the number really squeeze all the way to 50 million. I think in terms of the quarter over quarter growth rates, these are pretty sustainable numbers for now. Now, where we change and where I find it a little bit hard to project out is how fast they are going to scale this number over here. Now, this number is actually the products per member. The products per member, the problem with this and how to scale it is that as new members come in at a faster pace, they adopt lesser products. When they adopt lesser products, the products per member will have an anchor, which is all the new members that take on very little products. Whereas a older SOFI member may take out a loan with SOFI, have a checkings account with SOFI, and then buy, sell, hold crypto, and do SOFI invest with SOFI, and they have 3 or 4 products. So because of that, this is quite hard to actually go and project out. If you ask me, conservatively, I see us getting to at least 1.55 by the end of the year, largely driven by adding back the crypto products, because I believe the crypto products being added into their ecosystem will largely be driven by cross sell. And they have been very aggressive in terms of the rewards that they give to get their members to adopt crypto. So I'm going to say that we're going to see a little bit of that effect flow through to their numbers over here. And then in 2027, you don't see much of an increase until towards the end of the year. So basically, what I've done is that I have basically assumed that it stays at a particular products per member for around 3 quarters. So you can see 1.66 for 3 quarters, 1.77 for 3 quarters, then 1.8 for a whole year, and then some jumps to 2. Okay. Anthony Noto said 2 to 3 products per member. I think 3, even by 2030, I'm not too sure. If they are continuing to grow members at such a fast pace, I am not sure whether they get to 3 products per member. I may be wrong, and if I'm wrong, definitely we will be hugely surprised to the upside. Later I can show you. But if we are not wrong, and this is how it plays out, we should still get a pretty decent returns as well. So this is the member number. I don't have much to change over here. Now, where I want to change it is at the bottom. Financial services. May be possible if they can grow SOFI Plus members. So I agree with you. It is possible if they grow SOFI Plus members. And like I said, it is SOFI Plus members increases the cross sell, which is at around 43%. But at the same time, you also have new members coming in that take on maybe one product only. They are just in SOFI for a home loan. Then these people will drag down the average the average, what do you call it, products per member. Because how the math actually works, for you to get an average of 2 products per member, you need one person with 3 products and one new member with 1 product. That gives you an average of 2. It doesn't mean that the existing members need to have 2 products. Because if the existing member have 2 products and the new members have 1, that's an average 1.5 products, which is basically where we are right now. So we need to see cross-sell continue to strengthen. All right. Segment data, financial services. All right. Over here, right? This is where. Okay, this is where I want to change my assumptions a little bit. You can actually see that financial services product as a percentage of overall products. Is this the accurate number? Let me just go back and take a look. 19,328, 87.2%. Okay. As I remember, 87.2%. And then the total products. Let's just use the total products over here. Okay, for Q1 2026, I'm just going to use their numbers, okay? I'm not going to take anything from there. Okay, and then this is basically, is it correct? 200, yeah, 283. Okay, so if you focus your attention on this quarter over here, sorry, this should change. And then this is the quarter that this is the upcoming quarter that we are interested in. Similar, this should change. This is the upcoming quarter that we are interested in. Q2 2026. Everything before Q2 2026, we are just going to use existing numbers and then we're only going to project from here on forward. Now, this means that financial services products, okay. I think this will go up to 87. This stays at 13. It doesn't do much. Okay, it doesn't do much. What we are seeing is that in terms of the amount of lending products that they are giving out, yes, it has spiked, but it is not so much until we see a huge difference. I think what actually spiked was the amount of lending revenue per product, or if you go back into the segment data, it is actually the originations per member that increased. So they didn't necessarily underwrite more loans, they underwrite bigger loans. Okay, so again, this might be SOFI choosing the type of customers that they go after. They rather originate bigger loans with customers who they feel safe lending out the money to, rather than originate many small loans with customers who they are slightly less confident on the underwriting. Maybe that is the way that they're doing it. Now, from here, I'm just going to maintain this. I do not expect a huge change in this. Now, you got to bear in mind, right? Basically, in this assumption over here, we are not accounting for stable coins. We are not accounting for big business banking yet. Again, I will add that in because that is going to be substantial. Okay, I will add that in. Right now, I can show you how I plan to add that in. But don't get too excited when you see the numbers. Okay, let me just pull this out over here. 13%. And this is basically, okay, this is basically going to stay at 87 and 13. Okay. Then, in terms of, okay, revenue or, okay, this is where we need to take a little bit more of a recency bias, or not recency, the recent news and account for it. Means I think next quarter we are likely going to see around 22.50, and then we're going to slowly start to increase 24.25. So my assumption is that this year, they will be focused on their lending revenue, right? And if that's the case in next quarter, we should expect lending revenue come in at, or should be around similar levels, 225 or even 220. 220 seems more or less at that kind of level. All right, $22.50 is going to be too low for financial services revenue per product. How do I know that? Because it's going to make the year-over-year growth for financial services come in at 30%. They are projecting 40%. How much do I need to get 40% growth? 24.20. Okay, let's do 24.20 then. Then this will be 24.50, $25. Okay, you can't even do that. Wow. So this is what I mean. Sometimes when you actually work the unit economics, you will realize that what a good business SOFI is. They just have no choice. Like the numbers just, no matter how conservative they try to be, it is still fairly decent numbers. So if you just take a look here, this is 26. If they come in with these kind of numbers for financial services revenue per product in 2026, they will come in at a 40% year-over-year growth. This is exactly what they are guiding for, by the way. This is not beating expectations. This is exactly what they are guiding for. Okay. And similarly, I think towards the end of the year, as they ramp up their financial services revenue again, that's when perhaps we may see them cut back a little bit on lending. So this goes back down to, I would say, just below 200. Yeah. I think this makes sense because this way, you first two quarters, you're averaging above around a 40% growth. And then in the last two quarters, you are doing around 40% growth. Okay, then you have the Galileo accounts. Wow. Okay, Galileo accounts, this is quite sad. You can see I expected all the way to have revenue scale up to $1.50. That is no longer going to be the case anymore. So you guys are going to see me build out the model live, and then you can see the video perhaps later this week. I'm just thinking for Galileo accounts, should we do a quarterly? I think maybe not. Give me a minute. All right, let me reply a text. All right. Okay. So I mean, let's just keep to year over year growth. That's fine. That is fine. Okay, the way that we are going to do this, well, we can't even do, what's this, 37. Okay, I think basically what I did over here is that I just assume around a 5 million accounts being added, which I mean, I guess it's pretty fair. Yeah, 5 million accounts being added per quarter. Uh, For the rest of the year, fair enough. 60 cents. And then you drag this out across all the way until 2027, 60 cents. And then you get to 65 cents in 28, 70 cents in 29, and that's it. And 75 cents in 2030. Why did I choose 75 cents? Very simple, because if you go back into the segment numbers, you can see that they managed to scale up to 73 cents over here in Q3 of 2025. Q4 2025, there's suddenly a spike over here. I think this is slightly out of trend due to Chime leaving. We do not know exactly the finances. They did not give us exactly. They told us that Chime paid whatever they would usually pay, but we do not know how that exactly breaks down. Why there's a sudden bump over here, not accounted for. But I think on trend wise, I'm basically saying it's going to take us the next 5 years for us to get back to Q3 2025 unit economics. I think that is a fairly bearish take in terms of a revenue perspective on the tech platform. Now, the reason why we are okay to accept this kind of substandard tech platform growth is because we are expecting lending revenue and financial services revenue to continue driving growth for the company. Let me just zoom out a little bit. So if you take a look at the numbers over here, this is going to be the growth rates. Okay, in terms of tech platform. Okay, they can't have a drop over here, right? So this has to be what, 10% growth? No, not 10%. 12. No, 15. Is that, yeah, around 15% growth. Yep. So you can see these numbers will get you to, you're just basically increasing by around 5 million accounts per quarter. I'm adjusting it to fit the narrative of around 5 million accounts increase per quarter. Because this is to me the most, how to say, this to me is my most bearish assumption for the tech platform. If the tech platform actually does this, I will actually be pretty disappointed, although it is part of my valuation. When I put this in as part of my valuation, please do not misunderstand that this is what I am assuming the tech platform will do. But I'm saying even if the tech platform sucks, let's see what's the valuation of the other parts of their business. Okay. All right. Okay. So we have worked out the growth rates over here. Uh, let's see how that works out for us in terms of overall growth rates. This, oh, if we are at 2650 over here, let's just, Okay. You know what? Let's just make it 2650 here. Okay, so okay, what I am struggling with is that when I was thinking about the financial services platform, I think that the newer members that come on will bring in less revenue than the older members who have already grandfathered into SOFI's ecosystem. So I'm just wondering whether or not, as we see members increase, whether or not there will be a little bit of stagnation of the of the revenue per financial services product. And I'm thinking whether like an average of around 2650. You see, if we already get to 2650 by end of this year, just to get to 40%, that means we probably need to the comms next year should be pretty good, because this year, if we are intentionally slowing down, next year's comms should be pretty good. What's the average growth rate over here? Let me see. Let's divide it by the sum of last. Oops, not sim sum. It's a 46% year-over-year growth. So basically, we are saying that in 2026, between 26 to 27, they're still going to grow financial services at around 46%. I think that is fairly reasonable. Then in 28, you can see this slows down to around mid 30%. And my assumptions will then be in 29, 30. They are still going to be relatively small, but at 40, 50 million, they are more of a mid-sized bank. Mid-large size bank. So perhaps we are not going to see, yeah, I think low 30% seems to be around there. So this dynamics of actually having revenue unit economics come down as members go up. I believe one of the management team, if it's not one of the management team, Data Driven Investing in the past, Chris Hager, had an article on this, which is why I projected it out the way that I did. And I think 25 for the rest of the. So the assumption over here is that we do not need to, and I think this really amplifies the effects of SOFI's member growth, because what you are seeing is that perhaps in the next couple of quarters, as we add a lot of new products into SOFI's ecosystem, yes, we are going to see a boost in terms of revenue, because all of these new products are adding new revenue lines for SOFI. Now, as SOFI perhaps come to a point where they are slowing down on rolling out new products, they are more into the phase of iterating the products to make their products better rather than adding new revenue lines to their ecosystem, and start to get more members into the platform, then that's where we might see the revenue per product start to fluctuate. And so our assumption, again, I think this is quite fair, that in 26 they grow by around 40%, 27 they grow by 46%, so mid 40s, and then they slow down. Mid 30s, low 30s, and then this should be around, yeah, or even 24. Yeah. I think this is a fairly acceptable trajectory. So this actually shows you that they do not need to heavily monetize a lot of their members in order to get to pretty decent growth. I think 24 is fine. This is, again, valuation. And when we do valuation, you have to do something that is comfortable for yourself. And you must be able to rationalize it. So, because otherwise you can just take $28, $27, $29, $30 by 2030. You could do that, but what's the rationale? So my rationale is that it will come to a point where you are saturated in terms of products that you have. And then from there, every new member that comes on board, it's going to lower down your revenue per product because they're not going to generate as much revenue for you. And that is what we're going to see as SOFI gets bigger, but that is perfectly fine because they're still going to be able to maintain a certain amount of growth rates. So perhaps over here, you don't see the... Yeah, I think over here, you might not see... Yeah, you might see closer to 30%, 26, 26, then this 23, 23. Yeah. Let's do 23, 30, 50 because I believe it's like 30% growth. I don't think you'll go much slower than that. But anyway, this is all just a estimate. There's no... I'm not saying that this will definitely happen. Okay, just an estimate. In terms of lending revenue, I am expecting that in 2027 we come back down. What were we doing previously? Lending revenue per product. We didn't even come down to 170. Lowest we ever got to was in the 190 range. Okay. So if that is the case, I would say that in 27, maybe we do not need, I don't know, we need to get more guidance from management from this, but perhaps we do not need to have so much, we might not need to have so much, cash flow anymore in 2027 to fund the build out if we are into the second year of the build out, because there will be another just one more year. So if you ask me, perhaps 190, I think makes sense. Because anyway, they are projecting out over 30% revenue growth, right? They're not going to slow down to more than that. Okay, so this is going to be closer to 180 in 28. Again, my expectation is that over time, SOFI is going to become less and less reliant on lending. And they're going to be more reliant on financial services to drive their revenues than lending. So you can see, right? I believe from here, you'll start to see sometime in the back half of 2027 where this starts to equalize again. According to SOFI's management, it seems like perhaps even in Q3, Q4, they may start to equalize this a little bit. So I might be a little bit conservative on the financial services front. The reason why I'm conservative on the financial services front is because later on we also want to factor in big business banking as well as SOFI USD as enterprise revenues. Because that's just going to add 100 million to the overall revenue per line item. Yep. Am I comfortable with this? I think I'm pretty comfortable with this. And then you see that towards the end of the decade, that's when financial services revenue will really significantly flip lending. So maybe I might be a little bit too... It's either I'm a little bit too bullish on lending or too conservative on financial services. Let me just go back and take a look at the quarterly numbers, then you can have an idea. Not segment numbers. Sorry, where is lending? So SOFI has a track record of slowing down lending. How much did they slow down? Even in their slow lending periods, right? It's only in 24 during the super high rate environment where you see them slow down lending to flat year over year. But I think beyond that, they tend to do low 20%. I think that's a pretty sustainable level where they seem to be able to operate at. So let's just assume that for the valuation. We are going to adjust the number such that this lending revenue here over time equals out to around 20%. So that means over here, we are getting 170. Yeah. All right. 170. Fantastic. 160, 150. Yeah. 150, 150. And then you just basically project that out through to the end of the. Okay. Then you see one problem. Once you look down all the way, okay, let me just. There's no real way to project out corporate revenue. Okay, so we're just going to use average. I'm just going to use the average of the last 4 quarters all the time. Okay, 25274. Let me change this Q5, 25274. All right, so I'm just going to use the average of this. Do I know for sure it is always going to be average? No, I do not. So let me see. Okay, for here, I'm going to do an average. Yeah, and then I'm just going to take a 10% increase over here. I think this is pretty fair. So corporate revenue, I expect to just increase over time, 70, 80,000, 70, 80 million. I think that's around there. Okay, so the problem is during this year over here, this is in 2029, we do not actually have numbers for SOFI over here. So these are the 2 years where you start to see a little bit of discrepancy. What do I mean? Now, if you take a look at the numbers over here, in 2029, we are getting growth rates close to around 30%, high 20s. Let's some. This is a 25% year-over-year growth, which means after 2028, because they did guide for, did they guide for 30% to 2028 or 30% for the decade? Let me just double check the numbers. Hmm. They say 30% for as long as we can. What is as long as we can? Let me see if I can get a better. That was during the Goldman. Sorry, I should be sharing my screen with you guys. I don't usually get to do this because we are always talking about things that happen in the market. But since the sticks are not moving today, I thought it would be a good chance for us to talk through this valuation, because otherwise, usually I'm just talking to myself and thinking to myself. So if you guys got any questions, you can ask. So basically, the way I do my valuation, very simple, right? As much as people want to tell you there's some sort of fancy method to valuation, at the end of the day, valuation is a little bit of an art and a science. Yes, you have DCF, you have how to choose the multiples and stuff like that. But for the way that we build our valuation, we do it through unit economics, and there are going to be some sort of assumptions involved. These assumptions, to me, usually need to be backed up by either some sort of metric that is trackable or some sort of management's promise. So in this case, how do I determine that this growth rate might be a little bit low and this growth rate might be a little bit high? Because I remember SOFI did quote that they're going to grow at approximately 30% through to 2028, which means that after 2028, they might not do that. But then again, when you go to the JP Morgan conference, they say 30% compound annual growth rate for as long as possible. If you can see this part, that am I sharing my screen? Yes, right. If you see this part that I highlighted over here, the way that we think about the balance sheet and the loan platform business is that we want to make sure that we have set our company to up to deliver 30% compounding growth for as long as we can in revenue. So through 2027, which means we do not need net interest income during this period of time. This is specifically around the loan platform business. Let me see whether. Today, the commitment we have made is that we're going to continue growing our revenue at 30%, do that for as long as we can, and at 30% incremental EBITDA margins. We have already gotten to 30% EBITDA margins, which is fantastic. And again, Anthony Noto on the podcast said that this is going to be a 40 plus percent EBITDA margins, which then he, in a sense, gives you the long-term trajectory of SOFI, right? 25% margins, net income margins. That's what he said on the podcast. Perhaps I should add a ROE segment over here. Let me just see whether I find the 30% quote. For how long did he say 20? Is it over? Okay, see, adjusted net revenue growth 30% from 25 to 2028. So it is normal that we see some sort of slowdown in 29. If this is around 30% growth, you can see the average over here in the last 4 quarters of 2028 actually is pretty close to 30%. So we are basically right on point in terms of our expectations. So that's how I do it. Okay. This is not saying that this is the best way or the only way to do it. This is the way that works for me. I look at the unit economics, and then the unit economics work themselves out for me. Right? If you just take a look, $26.50 to $27 financial services revenue per product, plus slowing down lending revenue to $180 to $170, slowest that they have ever done. Why? Because in the past, they have grown when they tried to scale financial services, lending was operating at a low 20% growth rate. My assumption is that towards 2028 and beyond, as they continue to scale financial services, lending will be operating at that steady state of around 20%. They seem to be able to do that pretty consistently without putting up much effort. So 20% seems to be SOFI's steady state for loans. And then on top of that, tech platform, nothing's happening. Okay, nothing is happening over here. Basically, they're not even back at 2025 levels by the time 28 comes around. That is my assumption. Okay, that is perfectly fine. Corporate income is just basically an extrapolation, and then you just give it a 10% growth every year. You get to 30% growth. This is on average 25%. So this 35% here might be a bit much. Oh, because I didn't change my corporate income. I need to change my corporate income times 1.1. No, even then it's still. So some assumptions here might be a little bit high. Because if I take the sum of this, divide by the sum of the 4 quarters preceding, this is a 32% year-over-year growth. This tells me the numbers, if you ask me, should kind of swap around. But how much slower can we grow? You mean this goes to 23? You see, the thing about unit economics, or the valuation through unit economics, you will end up having to put in some very ridiculous numbers in the unit economics in order to get to the kind of guidance that management has told us. So my assumption over here is that after 28, we will not grow above 30%. How do we do that? Oh, we lower down financial services revenue. But will financial services revenue suddenly drop from 25, $26 in 2029 down to $23 in 2030? Unlikely. Unlikely. Will it even drop from 27 to 25 over here? I don't know. It seems pretty unlikely. So then you go back and then make slight tweaks. So I think $26 over here is okay. Even 26.50. So we scale it down like a pyramid to 27, then we scale back down 26, 25 like that. Then 24, 24, 23, 22. Okay, what changes then? I would say the only thing left that I have to change is lending. I think this is decent, right? That means you assume lending drops from 150. Oh, wait. My mistake. Is this doable? 30%. 30% in 29. That's not I think this is fine. Conservatively, I think this is fine, which means that we grow at around CAGR of around 30% all the way to 2028. In 2029, we're expecting around 28% growth, and in 2030, we're expecting 25% year-over-year growth. I think this is perfectly fine. Then, this is where Anthony Nodo's comments came in, and they were pretty important. So in Q1 2026, we are at, what's the number here? 15.3%. Okay. Let me just double check that. 17782, 177. Why are the numbers different? Well, did we not? Okay, I'll figure this. This is why. You know what? I should have created a completely new file before I let Claude mess with this. My numbers are a little bit off. Q4 2025, what's the adjusted net revenue? Let me just go and double check some of the numbers. I think there's a mistaken number in Q4 2025. Where's Q4 2025? Let me go back into. Give me a second. Q4 2025 income statement. Let's go quarterly. Where is it? Let me just download. Let's go straight to their SOFI's earnings and presentations to take a look. Because I'm getting total net revenue, I want adjusted net revenue. Okay, let me see total. Where are we? Yep, adjusted net revenue over here. 1012835. Okay, 1012835. You know what? I am pretty sure. Let me just work this out. I'm pretty sure I have done something wrong over here. 456741. This is okay. Okay, I think my lending. Oh, I must have screwed up a formula on lending. Lending is 486466. Everything else is correct. Yeah. Okay. Let me just go back over here just to. I think the formula didn't get copied over because in the segment over here is correct, in the valuation here is wrong. You take that all the way down. What do you get? Tech platform. Tech platform was okay. 122373. Oops, wrong one. 122373. Accounts have changed. Let me just yeah. Okay, I think I found the mistake. Let me see, Galileo platform Q4 over here. Yep, fantastic. 121, everything is correct now. 173. Okay, numbers look good. So 13. You see, based on our assumption, okay, again, this is not my Q2 projection video. We'll have to wait for June, July to come about to perhaps have slightly better news, and then on that front, and then we'll see how that goes. Okay, but for now, I am expecting perhaps a slight increase of products per member to 1.53. Again, this is driven by huge influx of crypto products. So 1.53. This will bring financial services up to products to 21,000 and $24.20. Why am I so specific? Because this gives you exactly 40 cents of 40% year-over-year growth in terms of financial services. This is the Q2 number, okay, my assumption. Then from here, lending, I'm assuming it's going to come in at more or less the same level because they told us that they're going to fund the build-up of the big business banking and all that across the next couple of years. So, yeah. So I think I'm just using whatever. Basically, if you can see in Q1, Q2, I'm expecting very similar performances. And then not much change in terms of unit economics, right? 60 cents, and then this is going to last for the next 2 years. Corporate revenue, everything over here, you can see on average, and I think it works out pretty well because on average over here, you can see the growth rate for SOFI would be around 41% for the full year. And this is actually higher than what SOFI's management has guided for, which is exactly what Anthony Nodo has told us. Now, then towards the back half of 2026, they will have to come in minimally with, well, they have to do 19% margins over here. So I think this over here is actually pretty possible. All right, they can operate at 24-25% margin. Why? Because 20% margins, because they need to generate around 18 cents in EPS. I don't think we will see a sequential decline again unless it is absolutely necessary, like this last 2 quarters, for which they will pre-warn us. If they did not pre-warn us, then I am assuming that we do not get a sequential decline in margins. Margins may stay the same, but there should not be sequential decline in margins. So 19%, 20%. Then thereafter, you hold 20, 22, you can say this 23, 24, and then 24, 25, 25. Let me see. Let me go and take a look at margins of the other companies in the industry to have a. Usually, in terms of margins, I don't like to assume. I just like to take a look at companies in the same sector and then use average kind of net income margins. Okay, JP Morgan is around a 34% margin. They are definitely not getting there. Visa, 51%, they are not getting there. Okay, surprisingly, Amex is only 16% margin. Affirm 9%, Lending Club 12, Robinhood 41. I would think that by the time, okay, they are not going to go above. Okay, because right now, if you listen to Anthony Noto's interview today, if they stop all the investing, they can generate 40% EBITDA, 25% net income margin today. I am expecting that until 2028, at the very least, they will not do 25% margins. Why? And so you can see in 2028, first half 24, second half 25, you average it out, it's still around a 24.5% margin. Why would they not do above 25% net income margin before 2028? Because this is supposedly the growth years for SOFI. While they are still growing, I don't think they will get to that number. It's only after that, then you can see in 29, you can expand out to around, I'm basically expecting them to get up to around 28%. Don't even hit 30% by the time 2030 comes around. I think this is fairly decent. Now, in terms of the dilution, actually it was quite bad in a couple of quarters last year due to the capital raises. But actually, you can see in this last quarter, dilution only came in at 0.7%. So I really don't know. I don't know whether 2% is too much. Maybe 1.5 might be more apt. I really don't know. Okay, so that means this needs to 24. Yep. Okay, if you're wondering why these numbers are not adding up, this might be because there are 3 decimal places. Yeah. There are 3 decimal places over here. So when 3 decimal places, some of these numbers don't add up. Okay. But we're assuming around 62, 63 cents, perfectly fine. Okay, 20% margins. Let's see, 24, 25, yeah. 27. How fast do they scale their margins? Quite fast, right? I don't know. 26. Let's just make it a step count up. 26, 27. Okay, that's fine. I think these numbers are perfectly fine. Okay, then this is where we will have to make sure everything is all summed up properly. 2026 numbers are summed up. 27 numbers, they are summed up. That's a 30%. Oh, wow. 2026 is a 40% year-over-year growth. So nice number. Okay. Wow, it's really on the dot. This is incredible. 33% growth next year. Okay. And then 30% growth in 2028. 27% growth, 29% growth. So in 2030, we are still slightly too fast. Why is that? Oh, I don't know. I don't know why we got this plus. My goodness. Nothing else? Okay, fantastic. Now, this is the growth rate without stablecoin, without big business banking. Okay. Without stablecoin, without big business banking, we are getting to these numbers. What I am going to do, if you want to be, because I don't want to mess up the numbers here, unless SOFI starts to report it in the line items, it will come here. Otherwise, things that are temporary, it will go here. So this is additional line items to consider. Big business banking, SOFI USD. I'm not even going to count SOFI Plus, okay? SOFI other crypto products. Okay, I shouldn't count SOFI crypto because that should be under financial services. Just to say these two line items. So so I'm going to show you a valuation with and without these two numbers, all right? Just give me a minute. Okay. So again, like I said, if it is something that is already in the line items, it will appear up here. Not in the line items, I am just doing my rough calculations. Then that's usually I will just do it down here. Okay, so what is the significance of big business banking now? We assume that they will get to around $100 million. This is what Anthony Noto said. In terms of the year-over-year growth, okay, year-over-year growth is basically just going to match whatever this is. They're just going to match the revenue growth rates over here. So these segments of the business, I am just assuming that they are going to match the overall revenue growth rates, which is unlikely. They should be growing faster than the rest of SOFI's revenue. But again, for simplicity's sake, I am just going to assume that they are growing at these levels. Oops. Okay, which means that big business banking and SOFI USD can add possibly $250 million to their top line by 2030. So again, this is going to become very bullish when I do the calculation, because Anthony Noto has been giving his projections of 2030 without big business banking, without SOFI USD. So before I make you guys a little bit too excited, hold your horses, okay? Hold your horses. We are going to just, okay, acknowledge that these line item exists, but we do not count them into the revenue yet, okay? We do not count them into the revenue yet. How do I block this out for you? I don't know how to block this out. Insert shape. Here, don't look first. Okay, later we will look at that. Now, from there, net income, you can see on an aggregated level, you don't get to pass 25% until after 2028, because, like I said, today we are already at 25% if we choose not to reinvest. But they will be reinvesting pretty heavily into the next 3 years. And I believe that as they continue to scale big business banking, crypto, all these are high margin business. Naturally, the net income margin will rise over time. So 26 will be a 17% net income margin, then 22%, 24%. I think it is a reasonable expectations over here, especially next year. Once we cut back on lending, we start to boost up the different financial services aspect of SoFi's business. A jump to over 20% margins on an aggregate level throughout the year is fine. Shares outstanding, basically, I've just taken the final, because the shares outstanding, if you take a look at the numbers over here, right, these are calculated quarter by quarter. So what I've done is I've just taken the fourth quarter numbers. By right, you should take the aggregate number of shares outstanding throughout the whole year and stuff like that. We're not going to get until so, we are not going to go to such granular levels. Okay, then thereafter, we are going to, let me do all my sum over here. Sum my EPS. Sum my EPS. Sum my EPS. Okay. They say they're going to CAGR their EPS at 40%. I think unlikely. I think they're going to do more than that. Yeah, I think they're going to do more than that. 40% is very slow for a company of SoFi size. I would say that perhaps the only one that is too bullish, maybe they don't get to $1 next year. If they really, really want to reinvest into the business, maybe they get to over 90 cents. That's the only part I think only my 2027 numbers might be a little bit on the bullish side. I don't know. The revenue growth doesn't seem to. So this is what I mean. Perhaps they may grow a little bit faster, 35, 36%, and then net income margin comes in slightly lower, 20, 21%, but you'll still end up with the same amount of net income and all that. So we will see how that works out. Okay, now, then from here, you get a revenue per share. Why? Because we're going to apply a price to sales ratio, because some companies in the fintech sector are still not profitable. If you want to compare it across the sector, then price to sales, you have to use a revenue per share. Earnings per share over here. Why? Because you can actually EPS, right? Earnings per share. Sorry, what am I? Okay, no, sorry. I suddenly caught myself in a mistake. I shouldn't be finding the EPS growth rates. I should be finding the CAGR between 2025 to that year. Okay, so should take the period is whatever the year is. Oh, so I need a bracket. But if you, I'm not too sure whether how many of you guys like doing Excel. But I like this kind of stuff. So present value, present. By the way, if you guys don't know, okay, if you guys don't geek out about this kind of stuff, when you key in Excel numbers, if you see a bracket that's negative, present value, future value, 72%. Okay, what numbers need to stay consistent? Okay, so F64 needs to be fixed, as well as F, everything else should move as I move. So if I move this over, 66. Look, so by 2028, based on our numbers, we will be CAGRing at 54%. They guided for over 40%. I'm just saying, this is not ridiculous, okay? This is not ridiculous. Above 40% doesn't mean they are going to come in at 41, 42. I think 54% CAGR from 25 to 28 is perfectly fine. And then it's 42% CAGR through to 2030. Even better. The reason for this is so that later when we use the PEG ratio, you will be using it. Usually we use it on a 3-year CAGR basis, but here, I just for the sake of simplicity, we are going to just compare everything based on 2025 until now, just for simplicity's sake. So going over here, our comms, I don't know. Oh, okay, because I, okay, I know why. I used to have a segment over here for all the world. Okay, you know what? I should put all comparables. If I want to compare them, you go to data, press stocks, choose Robinhood, you get this out. All right. Who else did I compare with? Upstart, Affirm. Some of these companies are not. Some of these companies are really not. Okay, I use American Express because Anthony Noto likes to talk about them. Block XYZ. Crypto. Okay, you know what? I should put Block here. Then American Express here and JPM here. I think that's fair. And then let me just bring all of these down slightly. All right. Arrange this to the top. Arrange this to the top. Oh yeah, this is the first time in a very long while that all of them are actually positive on the PE ratio basis. Because in the past, Affirm and Upstart used to be negative. this, ticker symbol. Yeah. Then move this up. All right. And then you get a sector average price to sales ratio of a PE ratio of around 51. Let's call it 52 times. Uh, June 2028 leaps versus call debit spreads. I haven't taken a look at the spreads. I will tomorrow, maybe when the markets are. Oh no. Tomorrow I'm out at night. Oh, on Wednesday I will take a look at it, or maybe I'll hop on midday, you guys time, midnight my time. I'll see how. I should be out tomorrow. Okay, so then here is where it starts to get interesting. On a price to sales basis, you can pick your year 25, 26, 27. You pick your year. Um, apply a. This is the current PE. Let me go and see what's Fiscal AI's forward PE. I don't know the forward PE off the top of my head. Fiscal AI. Okay, Hood's forward PE is around 40 times. I mean, JP Morgan, understandably, is quite low. It's 14 times because it's JP Morgan. SOFI is around 30 times forward PE. Okay, wait, give me a minute. Forward. Let me just take a look at all this. All right, so if I take a look on screen, let me show you what I'm seeing. Oh, the thing is, this is only going out 1 year, so it is only going out 1 year. If you are looking at, yeah, I mean, okay, technically it's not a forward price to sales ratio, because if you're counting forward, what you're saying is that right now, SOFI is trading at what? 1556. 1556 divided by 0.62. Right now, SOFI is trading at a 25 times forward price to earnings. Now, what I'm saying is that I am expecting the PE ratio to expand by 2026 to even 40 times. We get to $25. Okay, if we are using the average PE ratio over here, you get to 51.9, which is again well within the realm of possibility. Then you, I should have put it forward there because it's confusing. Then you end up getting to $32.36. So it depends, right? Because SOFI is currently trading at a 25 times forward PE. I think this is way too cheap. It should be closer to perhaps 35 times. And for me, that would mean that should be trading at around a 45 times PE. Okay, price to sales. What is the average price to sales ratio over here that we are seeing? Wow, I didn't realize Visa was at 14.4. Okay. 4.7 plus 14.4. Okay, I'm doing this manually. Give me a quick second because I think it's faster. Plus 0.31. Well, Lending Club is 1.3. Okay. How many companies are there? 1, 2, 3, 4, 5, 6, 7. An average of 7 times price to sales. 7 times. Oh, will you look at that? Right? You basically, we are saying that by the end of this year, SOFI should be back at around $25. Oh, you know what? I haven't really looked at Futu earnings, although I know they own like Momo and stuff like that, but I haven't actually looked at their earnings. Would you look at that? That's actually not too bad, right? 2026 price to sales, this is the average. Okay. Then again, if you for the PEG ratio, we are always going to be basing off 2025 so that we are accurate in terms of because earlier on when we calculated the CAGR over here, everything was based on 2025. So we're going to use the base year as 2025. Um, the EPS that time was here. What is C11? Okay, it's the current PE ratio. Okay, so next year, if we are trading at a 40 times PE. Oh no. How the hell does this work again? I forgot how my PEG ratio works. Oh, right. Okay, wrong. This is the one where I got messed up. Shit. Give me a minute. Okay. Basically, this is the one where Anthony Nodo was talking about it. Actually, I don't exactly know where he gets his numbers from. Is it from here? You know what? I'm going to do something extremely lazy. How many of you have done something like this before? I'm not going to calculate everything again. Where's my PEG ratio? Robinhood is at a negative PEG ratio. That's strange. Basically, let me just take a screenshot of the PEG ratio, dump it into Claude, and ask it to find the average for me. Yeah. Why is Robinhood's PEG ratio negative? Give me a minute. Let's see. And also to see why the average 1.26. You know what? So Anthony Nodo was right on point when he said that the average PEG ratio was 1.1. The average over here is 1.26. Okay. Yeah. Okay. I mean, it basically Claude says maybe some of the numbers are inaccurate. I don't exactly know why the PEG ratio on fiscal year is showing negative, but I mean I excluded that so that we don't have any noise in the data because the negative number is going to skew the readings. But on average, you can see earlier on, basically, the average PEG ratio is 1.26. So again, for those of you who are perhaps new to PEG ratio and y'all didn't understand what Anthony Nodo is talking about, let me just go back here, share my screen. PEG ratio, very simply, is that you take the P ratio, divide it by the growth rate. Okay, you take the P ratio, divide it by the growth rate, and then that should give you your PEG ratio. And so what Anthony Nodo is saying, you solve for the PE because you already know the growth rate. So Anthony Noto's argument is this. Where's the drawing over here? Let me zoom this in. Anthony Noto is saying that you need to solve for the PE ratio. How do you know what is a good valuation for SOFI? You have PE, you divide it by the growth rates. Now, the growth rate, although it's in percentage, you don't divide by the percentage. You can divide by the actual number itself. So if your PE is 40, right? And your growth rate is 60%, you don't take 40 divided by 0.6, you take 40 divided by 60 itself, okay? And then you end up getting your PEG ratio. This is the formula that we are talking about. Anthony Noto is saying that you use your 3-year average PE, okay? So whatever PE that you assume what kind of PE ratio do you assume SOFI is trading at? Well, if you take a look, let's say assuming in 2028, this is their, let's say we're using this number over here, $1.34. $1.34 means that SOFI will be growing at around 54.6% over, you don't know what's the PE. Feels like a math lesson. And then the PEG ratio, Anthony Noto says 1.1. I think this is justified. We have just seen with Claude that the average of the PEG ratio for all the companies, JP Morgan, American Express, and all that is 1.26. We'll just use 1.1. Then simple math, 1.1 multiplied by 54.6. And again, I just want to say it is not crazy for SOFI to be trading at around 50, 60 times PE because it has just turned positive. It is a very, very young company, relatively speaking. The multiple will compress over time, not so fast. And at a point in time, just a couple of months ago, it was trading at 50, 60 times PE. So it's nothing out of the ordinary. 54.6 times 1.1, you end up getting a 60 times PE actually. So this is my assumption. What Anthony Noto, I should use blue color since it's Noto. Anthony Noto is basically saying in Amit's interview, and I believe he said it before, I'm using 54.6 over here. Anthony Noto doesn't use this. He's saying that we are guiding for 40% year-over-year growth. So if you take 40 times 1.1, if you take 40 times 1.1, you get a PE of 44 times. And my PE ratio is 60 times based on. So if you think SOFI can grow at a 54% CAGR over the next 3 years, you should assign it a 60 times multiple. If you think that it can only grow at 40% CAGR over the next couple of years, you should assign it a 44 times multiple. That's how Anthony Noto gets to his answer. So basically, what do I need? Okay, I need to assume the PEG ratio is 1.1, right? And then we work backwards. I can't remember what I was doing. So after I explained this, I had a brain fart. My year, okay. Let's just 2028. 2028, it selects the EPS. The growth rate. Okay, it should select the growth rate as well. X lookup. You're looking at C. Okay, fantastic. The only thing is you are not looking at the correct. Oh, you're looking at 84, KF and K84. Fantastic. Let's put this. Let's put it one decimal place. Centralize this, save it. So the assumed PE ratio so take a PEG ratio, divide it. Yeah, get a 60 times PE in 2028. And then this number will change as you choose the year. Again, so this basically will change for you as you choose the year, right? So it gets quite aggressive because you are. I think a PEG ratio to me is more accurate when you project years out. Because you're going to go this coming year, you're basically saying SOFI should trade at 80 times PE, which is quite a stretch. But again, that's not how we use PEG ratio. Usually, 3 to 5 years out is a good time frame to use the PEG ratio. So 28 over here, even if you want 2030 over here, you get 46 times. All right. So why I'm using 2028 is because Anthony Noto has been using 2028. And so to be very, very fair, everything should be changed to 2028. Over here, on a price to, okay. Uh that means I don't actually need this because everything is all grounded based on you know what? Let me just leave it there first. So the correct way to do this, I'm so sorry. This is the part where see, you guys get to see. So the PEG ratio assumption is 1.1 times. Okay, wait. No, the year should be on top. Once I choose the year, this is the PEG ratio, 1.1 times. Fantastic. Then you got the 2x lookup. The PE ratio should be what we saw for at the end. So you have a 1.1 times PEG, okay, based on the year. Let me just double check. The numbers will change. Fantastic. So we're using 2028 because that's what Anthony Noto has been using. Then from there, you get a P ratio. Okay, your P ratio, as we have just calculated just now, you just take your PEG ratio, multiply by, multiplied by the whole number of your growth rate. So you get around 60 times. Let me just cycle this down. Okay, P ratio 60 times. Then from here, price target. This is what we like. Sorry. Where is my price target? Where's my EPS for this year? EPS for this year, not 2028. EPS for this year. Is that? Oh, sorry. By end of the year, so we are using this times the 62 cents. Is it? I'm confusing myself. Give me a second. Let me just work this out. Thoughts. Let me just. Okay. Where are my notes on this? Hmm. Okay, so the thing about the PEG ratio, and this, I think this was the problem that I had the last time. Uh, and I believe I got quite a few comments about it as well. Because when I was doing the PEG ratio, for 1 year out, you get an extremely high number, which is like 80 times PE, which is pretty ridiculous if you ask me. I don't think we are in any kind of environment where we can assume SOFI will get to 80 times PE. But if you use a PEG ratio, you are looking out 3 years. And when you're looking out 3 years, it's a bit hard for, because if I take the PE ratio over here, which is 60, I multiply it by today's earnings per share, which is around 36 cents. Is it 36 cents? 38 cents, I think. You get to a fair value of around $23. But that's not what we are trying to do. We are trying to get to a 2028 price target. So that is why during, okay, so I need to work this out again. Okay. The reason why this year was over here is that so that I can choose. Okay, I can choose the EPS, so I don't always have to go back to. Oh, okay. That was why I put it here. Okay, I'll fix this later on. It's already 1:30. My goodness, we've been going on for 2 hours. I didn't realize this was such a long build up. Let me just figure this out. What's the best way to represent this? Okay, now basically we have gotten a 60 times PE. For those of you, if I'm not being very clear, let me just. Okay, so if I'm not being very clear because I'm rambling and talking to myself, basically what I'm saying is that we have already used the 2028 growth assumptions that Anthony Noto has given us. Anthony Noto has applied a 44 times PE to the earnings today, and that's how he gets to whatever assumptions that he's getting of around, I think, mid $20 kind of range. That is the fair value. The way I look at it, similarly, if I take 60, I apply it to, I think, the 38, is it 38 cents EPS if I'm not mistaken? 39 cents EPS. If I take 60 times 39 cents EPS, we are getting to a fair value today of around $23.40. But I'm not trying to find the fair value today. Firstly, okay, I mean, granted, we need to know the fair value today to know that SOFI is tremendously undervalued. So, yes, fair value today is $23.40. The thing is, I don't think I can aggregate the price like this, because what I was trying to do over here is to aggregate the price to sales uh, price target, the PE price target, and the PEG ratio price target, but it all does something slightly different. Because the PEG ratio gives you the PE ratio to apply today. But basically, over here, in your price to sales and your price to earnings, you just have to assume a multiple that you think is reasonable uh, for the company to be trading at in 2028. So it is a slightly different. Yeah, so I will have to clean up this part over here, but we're basically getting there. Okay, so to make things very easy for everybody, what this means is that today, fair value of SOFI is at $23.41. Fair value of SOFI. Because if we assume that SOFI is going to get to their 2028 target of $1.34, which is a 54% CAGR, if you believe that, fair value for SOFI today should be at $23.40. Okay, the fair value. Now, this is based on the assumption of a 1.1 times PEG, but we actually know the industry right now is trading at closer to a 1.2 times PEG. So again, that will change. So the fair value of SOFI will be somewhere between 23.50 and 25.50 fair value. Okay. Now, does it deserve to trade at a premium to its fair value? We can argue that it should. Okay. But right now, with the state of the macro environment and all that, that's why it is trading at a discount to the fair value. I think in a better macro environment, once we see home loans start to come, once we see rates start to come down, once we start to see a lot more clarity around inflation and the labor markets, I believe we will go back to be trading at around this PE, right? 65, 70. We were just there in the end of 2025. So this is really, really not something that is completely out of the realm of possibility. Do I think we see this by this year, hopefully, after the midterms? But I think at $30 over, that was okay. Now, then here is where it gets interesting. In 2028, if you take a 40 times PE, which is around what Robinhood is trading at, okay, to an EPS of $1.34, you end up at a price target of around $53 in 2028, which is a 60% CAGR from where we are today. All right. Because you can't use PEG ratio in 2028 unless you do the PEG ratio from 28 to 30. So this is where this comes in. If I do a PEG ratio from here, 2028, all the way until 2030. Yes. Okay. Then the growth rate over here is basically okay. I understand. Now I know what I'm doing myself. Okay. I'm not going to confuse you guys, but I will explain it in a put together video. But basically, all you need to know, based on Anthony Noto's numbers, today's SOFI's fair value should be between $23 to $25. And in terms of their 2028 targets, if you expect around 35 times PE, they're at $45 by 2028, which is a 3x from where they are today. That's a 52% CAGR over the next, I would say, 2.5 years. I think this is extremely, extremely doable for the company. And so I think for most of us, if SOFI gets to $45, we should be pretty set. This is like nearly a 6x from like the $7, $8 that we were buying it. All right. Anyway, okay, so I think I fixed this already. I will just have to take away this aggregate price target because this is inaccurate. This includes the PEG ratio one over here, where the PEG ratio helps you find the fair value today, not the projected value in 2028, unless I make some adjustments. But that's fine. Okay. And then all of this is done without even considering the addition of Big Business Banking and SOFI USD. Now, to find out the valuation, when you include in Big Business Banking and SOFI USD, you have to stay tuned for the video coming out this week, right? And yeah. And with that, we've come to the end of the stream. I've been on for 2.5 hours. Well, thank you for at some point in time, so I saw over 50 people here. So 51, I think that was the highest that we got. Thank you very much for spending your memorable day with me. I know markets are not open and I'm just rambling trying to fix the spreadsheet. So, I hope this has been slightly insightful into how we actually use the unit economics to backtest the valuations and to understand my thought process. Because usually people just take a growth rate, slap it onto the number and project it out. But to really understand the business, you have to understand the unit economics, and then you have to find points within the 10K, 10Q, and transcripts to justify some of your assumptions. and then to try and match that. So it's a little bit of an art and a science. And so recently I was talking to some of the fund managers from Capital Group. Capital Group, I believe people in the US should be pretty familiar with them. They are an asset management company with over $3 trillion of assets under management. And because they own huge parts of company, and one of the biggest holdings that they own is actually Broadcom, they have a seat on the board of directors, and that allows them to understand the unit economics of some of these semiconductor names. And so when they project out the earnings for these companies, they also do it from the ground up. And so I was talking to the fund managers over how they try and value Broadcom, and I have to say it's really quite insightful. I am not like super technical when it comes to semiconductors, so I wouldn't say that I understood everything that he said, but it was a similar kind of it was a similar kind of understanding of how their technology is better than other competitors in the space, and why would people choose their technology over another competing technology. What are the metrics to understand that they still own that competitive advantage? And this is something that sometimes fund managers get greater access to than retail investors. Just rolled over my 403 to SOFI IRA and joined the SOFI Plus. Wow, fantastic. So I mean, the SOFI Plus right now sounds like a fantastic deal to me, in my opinion. But I'm not in, yeah. I mean, SOFI looks to be expanding in Latin America and the US. And so it seems like I'll get to try Robinhood's product before I get to try SOFI. But I believe if SOFI expands, or when SOFI expands into Asia, their office should be in Hong Kong, because they already have an office in Hong Kong. Okay, so again, summary before we call it a day, because I've been yapping. Using the PEG ratio, Anthony Noto told us 44 times PE is a fair multiple for SOFI today. Personally, for me, I think 44 times is basically you're expecting SOFI to come in right at expectations. I do not expect that. I expect them to come in slightly higher. My own calculations bring me to around a 54% CAGR by 2028 instead of a 40% CAGR. So with that, my PE ratio is closer to 60 times PE, because we are using a 1.1 times PEG. Apply that to the 39 cents EPS, that gets you to a fair value of $23.40 today. Now, if you are looking out to 2028 at $1.34 EPS, if they are trading at around a 35 times PE, that at the point in time, because they are a slightly more mature company, then the price target for SOFI would be at around $46.78, making it a 52% CAGR from today, or nearly 3x from here. And so with that, I'll bring the stream to the close. Have a nice day, everybody. Thankfully, everybody's stocks are at the same price as they were last Friday. Have a great rest of your memorable Day. And for Singaporeans, have a good night.